traders holding bets steady this morning after that UK CPI print. CPI dropping, but it did come in a little more than expected. But that's because, of course, yesterday at the hot wage data, we saw higher expectations of rate rises. So they've already kind of done that move this week. What do you make of the data?
Indeed, traders seeing a peak rate of about 6% for the UK. And our economists at Bloomberg Economics reckon that would trigger a recession. You've actually had some analysts at TD Securities and Saxo Bank off the back of yesterday's jobs data seeing a half-point hike in September. But, of course, we still have more jobs and inflation data before the BOE's next meeting. If you break down this latest batch of numbers, headline CPI, as you say, hasn't fallen as much as economists were expecting. Why? Well, the main driver upwards was transport costs, but the main drivers downwards were food and energy costs. So if you strip them out, core inflation has held steady even though it's expected to fall, and services inflation has actually risen to 7.4%. So it's the highest since March 1992. If you break down why, ING says that that's because of a rise in rents and airfares. So they're not too concerned, but nonetheless, overall for the Bank of England, it is a bit concerning because of, as you say, you mentioned wage growth. The concern is domestically generated inflation. That's what those jobs numbers pointed to, and hence why you've seen the pound rising slightly on these numbers. But as you say, bets for peak rates staying the same.